This is the Investor Connect podcast program. I'm Hall T. Martin. I'm the host of this show in which we interview angel investors, venture capital, family offices, private equity, and many other investors for early stage and growth companies. I hope you enjoy this episode. Well, hello, this is Hall Martin with Investor Connect. Today we're here with Jonathan DeYoe, President and CEO at Mindful Money. Mindful Money is a comprehensive financial education and wealth management firm that brings mindfulness to personal finance. Mindful Money practices a behavioral approach to personal finance. In a world that is market-focused and performance-driven, they are goal-focused and planning-driven. If you are just starting out, they have courses, digital planning tools, and evidence-based portfolios. If you are nearing retirement or selling your business, they have personal services to support you as you move forward into this exciting new time in your life. Jonathan, thank you for joining us.
Oh, it's great to be here.
Great. So what was your background before investing in seed deals? What did you do before this?
So it's a great question. There's actually two strains of my background that come together probably in 2017. And the one part of the background is, I was raised without much in terms of financial well-being. But my dad always talked about the importance of small business and the importance of entrepreneurship and the importance and so I got this really, when I was 8 or 9 years old, I started being steeped in investing and in business and understanding taxes and again, we didn't have anything. So I also at the same time I really wanted to be financially successful when I was a kid. That was something that was really important to me in my middle school and high school years. But the second strain starts when I go to college. My first 6 months or 3 months in college, I'm studying finance because that just made sense. And then I got bored and I took a detour into philosophy and comparative religion. So I spent, 4 years of undergrad and 3 years of grad school studying a variety of religious enterprises and a variety of religious experiences, and specifically focused on Buddhism, mindfulness, meditation, and ended up dropping out and getting a job at Dean Witter. So I started, actually going back and doing the thing that I did younger, and really, really loving it, except, it wasn't small business. It was looking at publicly traded companies. So I spent the first many years of my career looking at publicly traded companies and entities that invest in publicly traded companies. And it wasn't until investing in a couple of my friends' businesses that I really got interested in seed again.
Great. Well, so who should invest in seed deals?
Well, 25 years in public markets and for me, and I believe that wealth is completely possible, maybe even advisable without any exposure to seed. All right. The first thing I do is I try to talk people out of this a little bit because, early stage companies are obviously very, very risky. The odds are stacked against success in seed investing. There are very few of these companies that come through and are really just incredible. There's very few Facebooks, and to get to a Facebook, you got to invest in 1,000 different things. Later stage investors, the other issue is later stage investors often squeeze out the early adopters. You can actually run into a lot of risk if you don't know what you're doing. But if you're going to do it, you should have, this is the kind of person, the character that should be thinking about it. Someone that has a deep interest in startup business, like has a deep interest in and an understanding of, and maybe networks regularly with businesses, understands cap structures, understands the kinds of things that you're going to be investing in, understands how a business turns a profit, understands some of the marketing, understands some of that stuff. Someone should be higher net worth. Because you have to be able to create diversification of your investments. And to do that with seed, you're looking at a lot of different individual holdings or a fund with lots of different holdings. And really, you got to be okay with the occasional 100% loss in a specific investment. You got to be able to contextualize a loss in the greater picture of your portfolio.
Great. And so how do you invest in seed?
Well, for me, it's always been personal relationships. My first seed investment was a local retail game store. And it was because I knew and trusted the founder. I think I originally purchased maybe 15% of the company, and I've since sold 5% of it back. I've 3x'd my return in the last, 15, 20 years. And I get a dividend from the company every single year. So that was, if I had 10 of those, that would be awesome investment, right? It'd be great. My next seed commitment occurred, this is probably 15 years ago. I made a commitment to this guy. If he ever launched his enterprise, I would invest in his enterprise because I just liked the guy. Like, you meet these people that are just incredibly smart. He was the smartest guy in any room he ever entered. And I loved chatting with him and talking with him. And I said, hey, if you start this company, I'll invest in it. And a lot of time went by, and he finally came to me and said, "Hey, Jonathan, I started the company where, I'm having a rough go, this, that, and the other." But he forgot that I made the commitment. And he said, "How do I get capital?" I'm like, "Dude, I want to invest in your company. What is it?" And so he told me about this. He built a chip, a silicon company, a silicon chip. And so we are talking currently to Amazon and Microsoft and Samsung for the A round. So I'm very excited about that one. That's great. So that's my first and second seeds, very personal relationship. And the third place I've was introduced to a manager of a pre-seed fund. And so for me, it's everywhere I've gone has been someone I knew. The pre-seed fund gave me this. The story was unique. It was not something I'd ever heard before. It was a personal relationship to begin with. But he said that, hey, what we're going to do is we're going to commit at least 50% of our fund to women and people of color. And the thesis was these founders don't get funding, and they're underfunded for dumb reasons, not because that the ideas aren't good, but because there's some kind of bias in the system. And I was like, that seems like a pretty good thesis to me. Let's invest some money in that. So it's great. And you know how this works. If you invest in a fund, you get access to the follow-ons. And so the follow-on investments from that, I've done probably 15 follow-ons out of that. And that's been really, really fun for me.
Great. And so what are the challenges with seed investing?
The first one is most fail. It's really tough to say which one's going to be successful out of the gate. I mean, the real big challenge is you got to get that diversification. One potential is not to do individual companies. Invest in a seed fund or a private equity fund, of course. But you got to realize that investing in a fund is going to be a drag on your overall performance. They have infrastructure, they've got expenses, they've got diversification issues, they've got to pay people. So there's much of the additional benefits of investing in seed. If you do it in a fund, much of the additional benefit is going to accrue to the general partner of the fund, not to the limited partners. So the flip side of that is you do individual companies. And if you do individual companies, you got to have a minimum of 10 investments. But if it's if you're thinking about $5,000 per investment, you're not going to have access to really good companies. You have to invest more and more broadly. So if you're going to do 10 investments and they're going to do $25,000 each, you have to have a minimum of $250K to invest in seed companies. And that's, if you're going to limit it to 5% of your portfolio, that means that's a $5 million portfolio. That's a stretch. There's not many investors that have that liquidity to create the diversity they need in order to protect themselves. And then finally, it's research, right? The challenge is you've got to look at 1,000 companies to invest in 100 companies to get the one company that's the really, really good investment. And so, I got lucky with my buddy the first time, and I might get really lucky with my second buddy, but not a single one of the ones in the fund have really panned out wonderfully. And so the bulk of my investments have been, follow-ons, and those not quite as promising, but we're still in it. So I'm still, good things could come. So I've also looked at like hundreds of these things. Clients bring them to my attention, and I don't ever invest in them, but my clients sometimes do. And we just kind of take the time and pour over the thesis that the seed company has, the business plan. What are they doing? What markets are they going to enter? It just, the big challenge is it's risky. The second biggest challenge is how you manage that risk is either by committing more capital to the space or spending a lot of time. So you got to have the time.
Great. So where does seed fit into your wealth management program?
That is a great question. The challenge is it doesn't in a universal way, right? So not all of our clients are accredited or qualified investors, for one. For two, and I realize that some rules have changed around that. But if you get access, if you're not a qualified investor or an accredited investor and you have access to a deal, it may not be a deal you want to participate in, right? The really, really, really good deals, unless you're really early or have, know somebody that's in the company or something like that, the really good deals you can't get to with small investments. They are cornered very quickly by, Kleiner Perkins and all the big seed funds are now moving down market. They're looking for earlier investments. So it's very difficult to compete. So it doesn't really fit into a universal application. So what I've done is I talk about it. I talk about how private markets and public markets are different. I talk about how Access to private markets for me has been through friends, through people that are engaged in the space. I don't like most of the funds that I've seen. I've seen lots and lots and lots of funds. I generally don't like them. There are some good ones, if you look at a bell curve of funds, there's always going to be 3 or 4 or 5 that sound just awesome. Of course, 6 or 7 years ago when they started, you had no idea, right? After the fact, it's easy to pick the winners, right? It's harder to pick the winners going out of the gate. So for us, it's been responsive. It's been educational, public versus private markets, and then it's been responsive. So people bring to me, here, Jonathan, I got this. I got one this morning. Somebody wants to invest in some Swedish company. Fantastic. Send me all the information you have. I'll take a look at it, tell you whether or not I would invest in it. And let's talk about the thesis. You know the owner. How do you know the owner? What is the thesis behind the company? Does it make sense to invest in it? So I recommend if you're going to start, do it with people you know, if you can.
Great. And so what role does seed take in your portfolio? I think the angel world used to have 3 to 5% of your discretionary funds going into these type of investments. But what's your take on that?
Yeah. So I think that the baseline is, 3 to 5% makes a lot of sense. I think in my personal portfolio, it's about 5% of my, I'd say there's 2 portfolios. There's my investment portfolio, but there's my life portfolio. And so the way it fits into my investment portfolio is about 5% of the portfolio itself. And I would recommend, given the steep changes in the public markets in the last 15 or 20 years, you may be able to shift to a little bit higher than 5%. Again, this is a very individual thing, and I wouldn't recommend anything in a situation like a podcast. But an individual who knows what they're doing could go to 10%. I think that would be fine. But that's very, very individual. The second part of my portfolio is my life portfolio, and this is what I mean by that. I think that all investing is based upon our ability to be optimistic about the future. So much of the public, if you pay any attention to like the media, and even many of our clients, they worry a great deal about what's the economy doing right now. What is the effect of politics on our portfolios? What's going to happen if tax rates go up and these types of things? And I wouldn't say that these things don't matter, but I would say that in every single scenario, there are business people launching new businesses. Those businesses will hire smart people, train them further. They will reach for success, and their enterprises will grow, and they'll try to do good things for all their stakeholders. Being involved in seed for me is a boost to my optimism. It makes me feel better when I see these people, fighting the good fight, starting companies, trying things that are new, and back when Uber was brand new, I had a chance to invest in a company that was, what we're going to do is we're going to be a bank so Uber drivers and Lyft drivers can get their paychecks sooner than when Uber and Lyft pay them. So they give them, it's like a credit deal for their paychecks. And I was like, hey, that's an interesting idea. Did I make any money on it? No, but somebody saw the opportunity and they made something of it. And I think that's really, really cool. It just boosts my optimism about the future.
Well, great. So let's talk about your book, Mindful Money. What inspired you to write it?
I think I was one of those people that had, an idea my whole life. Like I thought I had a book in me. And so for many, many years, I had this idea for a book. And the final inspiration came from a friend, Alice Walker. We were having a conversation in March of 2009. And I was explaining sort of my long-term investment philosophy. And she told me that I had to write a book. I, knew I wanted to write a book, but when a Pulitzer Prize winning author tells you have to write a book, that's a rule. You have to write a book. So I started writing, and in 2017, so 8 years later, the book was finally published. And she said, sort of as an incentive, hey, Jonathan, if you write this book, I'll write your foreword. And so that was awesome to have her write the foreword. That's probably the best part of the book, actually. You should get the book just to read the foreword.
That's great. And so who's the book for?
I've struggled in the industry of wealth management. We tend to always move up market. We always want to work with bigger clients with more assets, and that enables the seed conversations. It's fun. But I've always struggled with this idea that if my parents or someone like my parents came to me, that I would say no to them for some reason, that they didn't have enough money or whatever. So I thought that was stupid. So the idea behind the book was, anyone who struggles with money and doesn't have access to really good, quote unquote advice, that could be the struggle could be like aligning their spending with life goals, or it could be, how do I save enough, or how do I invest wisely? So in the book, I try to present the simplest path that people can follow by themselves. I wanted to reach an audience that didn't have access to good advice with the book. The great corollary for me is a lot of people read the book and called us up and said, "Hey, I like your philosophy. I'd like to be a client." That was never the intention. It was always created for people they could do it themselves, that didn't have access to an advisor.
And so how should one use it for their work?
Well, it's easy. The book is designed for that. If you read it, and there's exercises at the end of every chapter. If you do the exercises, then at the end of the book, you have a mindful personal financial plan that aligns goals and resources with a simple investment process that brings those goals and plans to fruition in kind of a calm and sane way. You don't have to outguess markets. I'd say stop predicting, start planning. And the book really helps people create a plan that they can follow.
Great. And so you talk about creating happiness. What are the things that create happiness?
So in the second part of the book, the first part of the book, we debunk the myths that Wall Street gives us. Second part of the book, we talk about these, what I call the pillars of happiness. Now, the pillars of happiness are things that the philosophers and monks have been discussing for thousands of years, and things that modern psychology has borne out with academic research. Now, I list 8 things, and I don't think they're exclusive in any way. They overlap a little bit, and I'm sure that people can name another one or say how these two are actually the same thing. But for me, they are health. Got to take care of your body. My story starts with my story of understanding what my happiness comes from starts with recapturing my own health. The second one is like learning and experience. You got to have good relationships. You got to have meaningful work. Some people call that purpose. You've got to be accountable to something besides, the whim of the moment. Be generous. You have to maintain that optimism, which is why one of the reasons I like that seed investing is because it really supports my optimistic take on the world. And then you got to be grateful. I mean, even when stuff's not working, going your way, you're still better off, especially if you're listening to a podcast, you're better off than the vast majority of the folks on the planet. Those kinds of things are the things that lead to well-being and happiness. And that's where we should really begin our thought process. Great.
And so how do you build a plan on those items?
The question is really, what is a plan, right? A plan is, a documentation of an intentional management of resources towards specific ends. The point of a plan, in my opinion, financial plan, in my opinion, is to provide a rational approach to what the philosophers call the life well lived. If a life well lived is the goal of a plan, then the plan has to be built on the foundation of personal values, life purpose, and the goals that we decide for ourselves, lead to a life well lived. So my question would be, what else would form the foundation of a plan? What else besides values, purpose, and goals would make for a rational basis for decisions towards an end? Like, I can't imagine anything else. And, I think, who was it? I think it's in Hamlet, right? Polonius and his son Laertes. Is that Hamlet? Maybe it is. To thine own self be true. It follows as the night to day. Thou canst not then be false to any man. I think you really have to know who you are, build your entire financial future on who you are, what you value, what's important to you. That's how you get there.
Well, that's great. Well, in the last few minutes that we have here, what else should we cover that we haven't?
We actually didn't talk about the courses. And, what I'd like to offer your listeners is I'd like to offer I'm sure the link will be in the show notes, but you can go to our website, mindful.money, and you can go to financial education. And we have a course there that is designed to help people uncover their values, figure out their purpose, and set achievable life goals. And we'll have that course for your listeners that they can go through and do it for free.
Great. We'll put that in the show notes. And I want to thank you for joining us today. How best for listeners to get back in touch with you?
The best place to go is to find out all our, everyone's got their own social media choices. And the best place to go is to go to our website. That's mindful.money. And you'll see up on the top there all of our social media. You can follow us on your chosen social media platform. You can also find us, my first name or info@mindful.money.
Great. We'll put those in the show notes and hope to have you back for a follow-up soon.
Sounds good, Hall. Thanks for having me.
Investor Connect helps investors interested in startup funding. In this podcast series, experienced investors share their experience and advice. You can learn more at investorconnect.org. Paul T. Martin is the director of Investor Connect, which is a 501c3 nonprofit dedicated to the education of investors for early-stage funding. All opinions expressed by Hall and podcast guests are solely their own opinions and do not reflect the opinion of Investor Connect. This podcast is for informational purposes only and should not be relied upon as a basis for investment decisions.